In this video, we're going to talk all about how to invest for beginners. Coming up next. Welcome everybody. This is Retirement Rescue, where we talk about how to make money, save money, and live well in retirement. In today's video, we're going to be talking all about investing for beginners. You know, one of the things that I really try to do on this channel is talk in simple terms. I don't always accomplish it, by the way, but that's what I try to do because I used to be a financial advisor. And one of the most difficult things for people, and one of the things that kept them from getting educated about investing, was the fear of feeling stupid. You know, investment people, they use buzzwords, they use things and they act like you should know about them, these concepts, and, oh, everyone knows this. No, they don't. They don't teach this stuff in school. You don't know this stuff. Everyone has to learn it. So don't feel bad if you don't know what you're doing at this point. That's okay. Everybody starts somewhere. So when we talk about being a beginner as an investor, there are several concepts that you need to get a hold of before you think about investing in the stock market. Number one, if your employer offers a retirement plan, it's really important to max that out before you invest separately in the stock market. Here's why. Most employers will match those funds up to a specific amount, sometimes dollar for dollar, sometimes 50 cents on the dollar, just depends. If you don't know, then find out. Go to your HR department and say, hey, how does this work? They'll give you paperwork on it that you can take home and read so you can figure out how it works. Max that out as much as you can because it comes out of your check before taxes are taken out. So basically, that money you would have sent to Uncle Sam for nothing. I'm not a big fan of paying taxes, but anyway, everybody has to do it. But instead of sending more money to Uncle Sam, you're using that money to increase your retirement because you will not pay taxes on that money until you take it out. So you get to use that tax money for free. Not only that, the taxes that you do pay are lowered because it comes out of your check before taxes are taken out. And yes, that's completely legal. I actually had someone ask me if that was legal. Yes, it's completely legal. And it's something that you should really take advantage of because it works for you in so many different ways. So if you have that option, and not everybody does, do that first. Now, before you start investing, you really need to make sure your own house is in order. And this is what I mean by that. You need to have an emergency fund, a cash fund that you can access that's not in the stock market, of 3 to 6 months gross income. This last market tumble we've had due to the pandemic illustrates why you need cash, and you need cash you can access. You don't know if you're going to have a job or not when something like this happens, and who could have guessed this would have happened? Nobody. And so you want to be sure you have that emergency fund so you don't have to cash out those retirement assets and pay penalties and taxes on top of it. So be sure you have that emergency fund. Number two, be sure you pay off your high interest credit cards. They're going to suck you dry. And that is money you could be using to invest in the stock market, but instead you're paying a high interest credit card. When we start thinking about the stock market and you have your little pile of money, doesn't matter if it's $1,000, $10,000, $5,000, it doesn't matter what it is. Let's say it's $1,000 just for ease of math. You have your little pile of money and you're going to invest it. The first question you need to ask yourself is, can I afford to lose this money? If someone were to sit here in front of me and take a match to 3 of these hundreds, would I be okay with that? You need an answer to that question. Investing is a long-term prospect. And those people who have their money in retirement funds just experienced 3 of those $100 bills getting torched because the market tumbled so far. You need to be sure you're going to be okay with that. This needs to be money you're not going to need to live on. This is money you can set aside long term, because investing is a long-term proposition. It's not a short-term. That's why I tell people all the time, it is very unimportant what the market does today, what the stock price is today. Investing for your future is long-term. That daily volatility doesn't have anything to do with how things are going to be long-term. Let's say you've asked yourself those questions and you're okay. The market goes down, market goes up. Either way, you're okay. You've got your money, you've got your little pile of $1,000. You're ready to invest. What do you do with it? Well, number one, I tell people to open an online brokerage account. E-Trade account, TD Ameritrade, Schwab, someone that doesn't charge you a lot of fees or anything of that nature. The reason I encourage people to open an online trading account, and specifically one of those, not your Robinhood or any of those that are just apps, specifically an online brokerage, is they have a lot of educational information and it's free. You can access, you can learn about different funds, you can learn about different stocks. They have a lot of research. So your ability to educate yourself is tremendous when you open one of those accounts. Now, why would you not just use a financial advisor? I used to be a financial advisor, and the way that they are paid has an inherent conflict of interest, in my opinion, for the most part. Now, financial advisors are paid in multiple different ways, but basically they get paid in some way, either through commissions, either through sales, either through a percentage of your assets. They get paid in some way. Some of them are hourly. But no matter what, you're paying someone else to manage your money. And it is my personal opinion that no one is ever going to care as much about your money as you do. When you get to retirement and you don't have as much money as they projected you would have, what are they going to say? Oh, my bad. You should have educated yourself. That's exactly what they're going to say. So before I have a whole bunch of financial advisors comment in the comments, I was one. So don't even with me. Don't even. But the reason most financial advisors really wouldn't be interested in you as a client is because you don't have that much money. I mean, until you get over $100,000, $200,000, there's not much for them to do. So, you really don't need a financial advisor until you get into the upper levels. And even then, you need to know what you're doing. So, get an online brokerage account and start educating yourself. Now, when you get this online brokerage account, you've got 1,001 options. You really do. The options can be overwhelming. My suggestion for you is to pick a really broad-based index fund, a Vanguard, a Schwab, a Fidelity, something that has low expenses, allows you to invest a small amount of money, and tracks the index. That makes it easy for you. You're not out there trying to pick individual stocks. If you're picking individual stocks and you don't know what you're doing, it's just like going to Vegas. And guess what? Vegas wasn't built by winners. People lost money. And that's what's going to happen to you. So do something that allows you to mitigate that risk. It spreads that risk out among multiple companies. You don't have to investigate every one of those companies. The fund is going to track with the index. So you can pretty much just figure out where the market is today. And that's going to be about what you gain or lose. It's not hard. And that is the easiest way to start. Having said that, I do want to mention there's two different types of mutual funds, because these are mutual funds. Mutual fund is anything that has multiple stocks in it. It's a mutual fund. There are mutual funds that are regular mutual funds. The price is decided at the close of the market. So if you want to buy something at 10 o'clock, a mutual fund, well, you're not going to really know what the price is until the market closes. That intraday volatility is not something you're even interested in. It's not something you can access. It has no bearing on your long-term investment strategy anyway. But there are also mutual funds that they're called exchange-traded funds. Now, those mutual funds have a stock price, just like a regular stock. So let's say it's $100. And it goes up and down during the day, just like a stock, even though it contains lots of different companies. If at 10 o'clock in the morning you wanted to buy it at a specific price, You could. But here again, just understand they're the same animal. They're just priced and bought slightly differently. But still, we're not talking day trading here where you're constantly churning those stocks. We are talking about investing for the long term. And this will allow you to go ahead and get your money in the market while you learn about different types of investments you might be interested in, or about specific stocks or specific sectors. The bottom line is you shouldn't be afraid to get your money in the market, especially when it's on historic lows. However, you need to be sure before you do that you're in the financial position that you want to be, and that you're not going to have to pull that money out anytime soon. So that money can sit there and ride it out. My upcoming videos will include a video on investment advisors, exactly how they get paid and why you may or may not want to use one. But until then, thanks for watching. See you next video.